everyone. I'm Rick Benson. Today is Tuesday, November 15th. Welcome to this week's In the Know Trader Show. On tap in our trader education portion, we're going to talk about that it's important to have the patience for your trade to come to your levels. We'll talk about that. And then in our sector focus, let's this week look at the material sector. It's one we haven't looked at for a while, and it's been doing fairly well recently. So we'll do a deep dive into it, both looking at the XLB on an outright basis, also as well as how it's performing versus the S&P. And then we'll go through the dozen biggest names in the S&P Materials sector. Here are the names. You can see they account for about 50% of the weight. So the top 12 names, 50%. Certainly that's different than some of the other ones, like let's take, for example, communication services, which between Meta and Alphabet accounts for close to 50% just in those two names. So better spread out here in this smaller sector. Importantly, I want you to know what we have for you as far as In the Know Trader products. Two of them currently, besides our coaching that we do for both individuals as well as financial advisors. We have a weekly tactical ETF report that comes out Thursday evenings. It goes through the macro markets. In other words, we go across the asset classes. We'll look at what's going on in the bond market and how that influences the decisions you need to make, both there as well as for the stock market. We'll look at credit spreads often. We'll go into the dollar and how it's affecting everything going on too, and often how it relates to something like precious metals like gold. And then we do a deep dive into the S&P. And we give you all the key levels that you need to know, as well as what I'm thinking about both short-term and medium-term in the market, so you can best position yourselves. On top of that, we give you a brand new ETF idea to trade each week. It could be long, it could be short. Occasionally, we'll do a pair trade where we buy one ETF versus shorting another to play the differential between the two. And then I also go through all open positions we have that we've accumulated over time and walk you through what you need to know each week in updating any trade we have on in order to potentially move a stop closer to protect profits, where we get out, etc. That's the weekly ETF Tactical Trade Report. We also have a report that comes out once a month called the 7-Eleven Report. The 7-Eleven Report is designed to outperform the S&P, which essentially is what any active fund manager tries to do on the, we'll call it the mutual fund side of the industry. All those funds that are actively managed and benchmarked to the S&P, the goal of the portfolio manager is to beat the return of the S&P. What we do in the 7-Eleven Report, and it's been hugely successful and something I highly recommend that you minimally take a free trial on to see what it's like, is we invest at the beginning of each month in no more than 7 of the 11 Spider Macro ETFs across the sector. So what are we talking about? XLK, XLI, XLF, which is financials, technology, energy, utilities, consumer staples, consumer discretionary, etc. There are 11 sectors to the market. We pick no more than 7 each month to be in with the goal of avoiding the underperformers. Year to date, we have outperformed the S&P through October 31st by 5.14%. We've outperformed 9 of the 10 months this year. That is outstanding, if I say so myself. That is a very difficult task to achieve. Since we started this report in August of 2020, we have outperformed the S&P by 10.98%, essentially 11% in just over 2 years. This would put us in the top 10% of all active money managers. Now, we don't actually manage your money, right? I don't take your money in. I simply suggest to you, I make my recommendations on what sectors to be in and how much to allocate to each sector. And we are killing it by doing that as compared to being in the S&P alone. So Something you really want to take a look at. If you've got money in spiders, or Qs, or any type passive index that is essentially trying to get the benchmark return, we are crushing the benchmark return this year and last year and the part of 2020 that we started in. So whether it's an up market or a down market, we have proven that we continuously outperform the S&P. If you're watching this, you're probably watching it on my YouTube channel. You can subscribe to it so that anytime you open YouTube, my most recent videos will pop up on your screen. To subscribe, go to youtube.com/InTheKnowTrader. And of course, you can follow me on Twitter at InTheKnowTrader. All right, let's get into the idea here of having the patience to let your trade come to the levels you want. Why is that important? Well, the market's made a huge move since the mid-October low. So in the month, we've had a significant gain. And today's another day that, as we record, S&P is up about 50 points or so. So it's having another good day. The PPI number came in better than expected. So it's another inflation number that came in better than the street expected. And bulls are off to the races, saying this is what you want to see in order to bring us back into a bull market. And we're certainly seeing that strong move off of the October low. When you look at charts, what we're often coming across now are trade ideas that have moved up so much recently that you kind of don't want to necessarily chase. And at the same time, we may not be high enough in this rally to really lean into it to think that we've got the top in place. So what do you do as a trader when you're above the support levels you want to buy at and you're beneath the resistance levels you want to sell at, but you're itching to trade? Well, there's a couple of things I can tell you with my over 40 years experience in playing this game. Number one, just because you're itchy to trade doesn't mean you should trade. A proper trade gets lined up when the reward potential is at least 1.5 to 2 times what you need to risk. If you look at your charts now and you don't see that you can at least get 1.5 to 2 times on the upside relative to where your stop out is, then it's not a good time to trade. And therefore, it probably makes sense to really curtail your trading until you get to levels that make sense to you. If the market gets a pullback, like I think it can, I do think some of this is overdone, but I'm not going to stand in the way until we get to the levels that I really want to see and lean into. Then I'm not really looking to do much in here. It doesn't mean I don't trade at all, but I look carefully at what I'm going to trade to make sure it makes sense. And I'm going to prefer to look for a chart that lines up and that I can trade at the levels that I want to trade at. Not that the market makes me trade at because it's moved up, and therefore if I want to trade today with the S&P at, where are we, 40.10 right now, I don't want to do anything in this area. I want to at least get 50 to 150 points higher before I lean into the rally. And I'm probably a good 100 to 150 points above where I want to do something. So I can day trade, I could do, minor things in the market, but this is not a location to where I want to make any significant changes. I've already done some of that on the lows, and earlier this year, we sold a lot on the August highs. So right in here, I'm willing to be patient. And let me give you an example here. Let me pull up a chart, something I was looking at. Let's go to charts, and I'm going to, just give me a sec here. I'm going to pop up another blank chart. And let's take a look at, here. Here's, let's say, a chart of silver. All right, so precious metals have moved up sharply in the last week or two as the dollar has fallen sharply. So you've seen the price of silver, for instance, rally. And I look at kind of the chart before I start annotating it. I look at it and I say, well, what sticks out to me? Well, clearly we've made the highest high since July. I look at how the bottom was made, and one of the things I can just kind of quickly see in my head, but I'll show you here, is that other than this quick couple day sell-off in September, we have a pretty good area of where the bottoms have been. So we know at 16 and a half, give or take, in the SLV, there's been support. Where has resistance been? Well, up until recently, somewhere in this neighborhood, we caught what was a low here and that we broke down from in June, gave you the highs in August, the high in early September. All right, but now we've broken through that. So certainly I look at this level in here. In fact, now I go back a little farther and I go back to February and I see, well, look what we've got here. We're getting closer to another proper or potential inflection point. But do I want to buy now to play for that versus what I need to risk? Because we know that on a sell-off, this could get back down towards 19. It's not a good idea, essentially, to do something here. It doesn't mean that the decision that you make to trade, whether long or short, might not work out. But the risk reward at where it's currently trading makes it tough to put on a proper reward to risk trade. So where is a place I might be interested in? Well, if we get back down somewhere towards 19, I at least have a sense that there probably should be some support in and around that neighborhood. And it doesn't have to be precisely at 19, but we know down there, it's a lot better to think about buying than at the current price of 1980. What else can I do to give me a sense of what might be coming? Well, this trend line from the lows is much lower than I would anticipate it coming to. So that's probably not going to be helpful. In fact, I can let's take that one away. Let's take a look at a shorter term trend line. I look at this and I go, that could come into play, but even that may not help me. So I'm not sure that's going to do something. Let's take a look at the cloud charts. And the cloud chart shows a breakout on the daily chart and that the conversion and baselines are lower than where I kind of the zone I want to buy, but I also know that they're probably going to move higher over the next few days. So they're getting closer to the range. So now I start saying, all right, now I've got a couple reasons that if we pull back towards that 19 area, I have better reason to think that that's a place to take my bullish trade, to put it on as compared to now. Now we can look at moving averages. I can add a stochastics chart. I can look at MACD. Has MACD crossed yet? Well, sure, MACD is now above the zero line, starting to flatten out a little bit. So if we get a pullback, I wouldn't expect a major one. And if I look at the trend line from, let's see, these lows, that also gives me a sense that a pullback to somewhere near the zero level may be good. So the more things I can line up, the better the chance that the trade can work in the future. So rather than playing this particular name here and now, as itchy as I might be to do something, my years of experience will tell me, hold off. Wait for my levels where I want to play, wait for the chance to play them. They may not come. If this just keeps going straight up, then I've missed the chance. But unless I have very good long-term reasons to get long, where a 5 or 10% move isn't going to bother me if it goes against me, because I think it's going to move 50% or more higher, then you can look at this and say, all right, looks like silver has a triple bottom in place. The dollar has peaked. You can put a story together where you may not need to be as precise about your entry because you have a longer term fundamentally based reason that you want to play a particular security, and you're willing to give up, if you were to buy it now, if it fell 10%, is it going to change your reason to be in this long term? If not, then it's fine. Then you can think of doing that, whether it's this name or any other name. I'm just using this as an example. If you think that the dollar near term sold off so much recently that it may be overdone, and that within a week or two, it could recoup some of the losses, then it's very possible that precious metals come off and you get a chance to buy closer or in the zone you want to buy. So that's why I say to you to have the patience to wait for trades to come where you want them to come and put your trades on, as compared to just necessarily doing something at market prices at any given time. There are a couple names that I've personally gotten into in the last 2 to 3 weeks where I had resting bids in at levels that I really never thought we'd see, but on the odd chance we would, I'd be willing to buy some names. So 2 of the names that I've bought recently for myself, these are not names I've put out as recommendations in any of the places that I put out recommendations, for personally, I have bought Amazon at 89 and change, and Meta, I think it was the day that made the low for the move because it was 88 and change. And I really didn't think I'd get either of those when I put those orders in months ago as resting bids, which were well underneath where the market was trading at the time. But I at least said, I'm willing to take a stand at those levels. And I had no issue in putting those bids in on the odd chance I could get filled. And I did get filled. The same way earlier this year, I bought, again, for myself, I bought Netflix at 164, which was also on the day that made the lowest low for the year, and that was months ago. Now, I still don't have Netflix. I wish I had, but I'm out of it and done, and that's fine. Still made some very good money on it, but I let the market come to me. I try not to chase or get forced into something, because I don't have to trade anything. As an individual investor, I can do what I want when I want, and so can you. So unless you're a portfolio manager that is forced to do something because it's the mandate that you have to have a certain amount of exposure in a certain name or certain sector, etc., you can wait for opportunities that you're happy with in order to put on your trade ideas. So don't let the market force you into doing something unless you're convinced that the move is real, long-lasting, and if it drops quickly against your entry point, that you're still okay with it. Otherwise, you need to be more patient to let the market come more to the levels you're willing to play at. And that doesn't mean the levels you're willing to play at don't necessarily move over time. They can move if the opportunity, let's say, again, just using this as an example, to buy this particular security, SLV, near the $19 neighborhood doesn't happen, and let's say this explodes to the upside, then maybe in the future I adjust where I'm looking to buy it. But have the patience to let the market come to your levels. Many times it does, and you'll get a much better entry point than simply chasing after something or listening to somebody on business television who tells you on a show, here's our play for the day, here's final trades, things like that. I'd like to see what the track results, the actual P&L are for all those final trades that we see on shows like we do each day. I suspect they're not particularly good at all. And part of it is because each day they're instructed to give a final trade. So they're forced into coming up with an idea, even if the idea isn't the best one. They have a timeline, they have a deadline, they've got to get, some trade idea together by the time they go, well before they go on air. So that's not something that really means anything to me, and it shouldn't really mean anything to you. Okay, that's today's conversation on being patient. Let's take a look at the materials sector. First, we'll take a look outright on the XLB. So we see that this recent rally has crossed the downtrend line from the double top that we saw early in the year. Even last week, we've gotten above the bullish propulsion level. However, it came on a week after an upward move. So it's disqualified, meaning that you don't necessarily jump on board this thinking that it's the right thing. If this week closes down and then next week closes up above what'll be this Friday's close and takes out this little double high, then you have at least a bullish propulsion signal that would suggest that this can ultimately make new highs. Doesn't mean I still buy it right away. I'd be more inclined if you look at the pullback to the trend line, where the baseline is at 77 and change, where the conversion line is at 74 and high change, and where the bearish propulsion level would be. We kind of have a zone in here that if you want to be a buyer, you're a better buyer than again chasing right now after this. Also look at a potential inverted head and shoulders pattern. So you still may get one more move down before you've got the left shoulder and the inverted head. You still may need an inverted right shoulder. Doesn't mean it'll happen, but again, it's all about, do you want to chase or do you want to let the market come to your levels? So that's what I'm looking at XLB right now. Let's also look at it versus the S&P so we get a sense of relative performance. And you can here, I put these two lines up before we started. I could even draw this from here. Oops, not with that angle. That's not what I wanted to do. Just a straight horizontal line. So again, a poke through it, but we have a pretty good sense of where in relative terms this is bottom. We have a double top over the last year and a half. And right now you're in the middle. Tough place to decide if you haven't already overweighted materials as a potential outperformer, which over the last couple months would have been the better thing to do. Now, of course, this is only a sector that represents something like 3% of the whole S&P. So it's a minor sector compared to healthcare, technology, financials, consumer discretionary. But this now here in the middle of the range is a tough thing to decide which way to go. Certainly, it could move higher. If you want to look at this in terms of putting on some additional weight, you probably wait for a pullback. Now let's take a look at the bunch of names in the sector. We're going to start with a name that a lot of people don't know. It actually does not have a lot of years of trading history, but it's the biggest weighted name in the sector, and it's LIN. It's Lind PLC. So it's a UK company listed here. And when we look at it, there's a lot of good things that took place on the bottom. A double bottom this year. Secondly, the second bottom came with a 13, right on the precise low for the year. Downside exhaustion of trend, as you know from the DeMark sequential model that I look at. Thirdly, the cloud's lagging line held within the cloud. So if I had happened to have seen this name at the time, I would have had enough reason to buy it. It's only hindsight now that I see it. It's not a name. It's not even a sector I pay a heck of a lot of attention to generally because it's so small. But a lot of good stuff lined up at the time to have taken the chance for the long side. Prices moved through the weekly cloud. We're getting close to what are the all-time highs. So there is some resistance up here. If we get through the resistance, then this targets something like 365 to about 375 or so. And so, decent looking name and did not do massive technical, damage on the break this year. Despite price having broken through the cloud, the lagging line held, and that was one of the keys for that. APD, Air Products. Different looking chart. You can see multiple lows that broke beneath the 200-week moving average. And a lot of times when you break it, people get ultra bearish. But it's in general, I don't get nearly as fussy as other technicians that, oh, if the 200-week moving average breaks or the 200-day, it implies it has to be going the other way. It's the long-term trend. You look at the slope of the line, and it at least gave you now, not until a couple weeks ago, could you get any sense that it's got a bottom again, but now it is playing up against the higher end of the range, which we've seen multiple times over the last few years. So again, from a risk reward point of view, it's not great to be buying here. Wait for a pullback towards if we get anything. So instead of paying $295, to me, if you get the chance to pay something in the mid 270s, you're much better off than chasing after it here. And just the way things have gone this year, a lot of times rallies, this whole year rallies have given back themselves at some point, and you do get a chance to buy on a decline. So same type thing. You don't have to necessarily even buy it before year's end. It's the type thing where we have a good sense of where on a pullback you're a better buyer than chasing after it here. Sherwin-Williams. 13.9 at the bottom. Again, a break of the 200-week. A lot of people get ultra bearish on that. I don't necessarily. It depends how other things line up. Notice the bottom on a 13.9 count, very similar to how the all-time high was made. Very close to the all-time high, 13.9 upside exhaustion. Now we have equivalent downside exhaustion. This probably gets up to the mid 250s as a target. So this is one that I could be more... I'm more inclined to maybe pay near current price than the other ones we've looked at. Corteva, CTVA. This is on now. This also does not have a long-term history. Made all-time highs, looks like last week on the rally, but we're in the context of a 13 count, possible upside exhaustion. Last time we had the only other 13 count in its total trading history. It was the high for many months. I could see this potentially extending up to the low 70s from the current 66-ish. So what's that, about 8% upside or so versus right now 8% downside until we find some support. So if you're playing this for the current trend to continue versus waiting for a pullback in order to buy if you're looking to play that direction. Freeport Mac, FCX. So this broke cloud, lagging line broke cloud. So it went into bearish posture. It still did bottom on a double bottom, and it's come back. I would potentially lighten up into the zone that's between 41 and 44 or so, or 40, what am I looking at? 40, 43, 41 to 43. I probably could take some off, especially if it took place several, let's say 3 or 4 weeks out from now when we were up here. I'd probably take some off the table. Not much else. I look at the big trading range now over the last couple of years, and we're kind of halfway. We're right in the midst of it. So tough to really get a big handle on it. I like how this bottom, the MACD, stuff like that. So I own some of this all the way from when it was trading. I think I bought this. I think I bought this down in here. Where am I long? Maybe $12 to $15. And I've gotten out of some of it this year, but I still have some left. So type thing, I may start selling some upside calls against what I have. Ecolab. 13 a month ago, bottom is right at its risk level, comes right back up. Long term, I'm going to take the cloud off for a second because it'll just be easier to see. But take a look at this. If we go back to 2018. So look at this line, triple bottom, long term, of which the third one gets a 13. I kind of like that. What's not great here is the big breakdown that we saw early this year, and then the downtrend that's been in place since. So if over the next couple of weeks we get a little bit to play with somewhere in the recent trading range over the last couple of weeks, might be something that I take a look at from the long side, because this does feel like it's a good bottom. Nucor and UE. Double bottom this year, triple bottom last year. This is a decent looking chart, starting to get closer to some resistance, but I kind of like it. And let's just put the cloud back and see. All right, so this week's, in fact, right now, as we speak, we're at the top of the weekly cloud. So I'm not going to look to be a buyer right now. Certainly we could pull back to the bottom of the cloud, and we know we're close to resistance. Another example of, as nice as this chart looks, from a risk reward point of view, it's a tough place to decide that here and now is the right thing to do, is as far as being a buyer. I'm personally not, even though it looks like a decent chart. I'd probably wait for some type of pullback. Newmont Mining, NEM, like we said, gold names, got a big pop recently with the dollar weakness. Otherwise, this has been a pretty lousy chart, and has somewhat limited upside. Take a look at where all these lows are from the past, this horizontal line. Oops, come on, hold on. Let's do it from, oh, this just doesn't want to play nice today. Let's try this. There we go. Look at how many lows were in here. We actually have the 200-week moving average back at that same level. Currently, the baseline is there, so if we got back there, that's not a bad place to, if you've got long recently, take some off. You're gonna be joined by other people who are trapped in the name into this range. So unless the dollar has a huge decline, my guess is there's limited upside there in Newmont. Dow Chemical, I think we'll finish off with this one. So again, not a great looking chart, double top from the last 2021 and 2022. This bottom is kind of an undefined bottom. So I'd look for some resistance up ahead between 55 and kind of 57 or so. Maybe it goes to play and fill this gap, but I'm not loving this. So I'd use strength to lighten up, especially if this has been, something you've held for a while. That's it for this week. I hope you enjoyed the show. I'll be back next week, and I'm Rick Benson, and this has been In the Know Trader.